What's up, everybody? Welcome to another episode of Hidden Forces with me, Demetri Kofinas. Today, I speak with Gary Shilling, an economist, financial analyst, and commentator famous for the prescience of his forecasting, most notably having called the bottom in what would become a 36-year and counting bull market in US Treasuries. He is the author of numerous books, including his most recent, The Age of Deleveraging, a strategic manifesto for managing wealth during an epoch of deflation. In this episode, we take a look at the tax cuts being proposed and the regulatory changes being enacted by the Trump administration. We consider their impact on the economy, on growth, and on equities as we head into the 9th year of an unusually long economic expansion. What does the employment picture look like for the U.S. economy? How do job prospects and wages fare in the face of rising asset values and growing debt burdens? If our guest is right and treasuries remain in a bull market, then what does this mean for the fate of stocks, commodities, and the U.S. dollar in 2018 and beyond? As always, you can gain access to reading lists put together by me ahead of every episode by visiting the show's website at hiddenforcespod.com. Lastly, if you are listening to the show on your iPhone or Android, make sure to subscribe. If you like the show, write us a review, and if you want a sneak peek into how the show is made, or for special storylines told through pictures and questions, then like us on Facebook and follow us on Twitter and Instagram at Hidden Forces Pod. And now, let's get right to this week's conversation. Dr. Gary Shilling, welcome to Hidden Forces.
Delighted to be with you.
It's great having you here. I was telling you that the last time I saw you for sure was in 2012 when we did the post-2012 election panel that Lauren, the former host of my show, moderated with Malden Economics. And Rich Yamarone was there. I think also Mohammed Al-Arian was there too.
Yeah. You know, Rich, I saw him at Bloomberg literally a week before he died. And
when did he pass away?
Oh, yeah. He died about a week ago.
I didn't know that.
He was hale and hearty. Matter of fact, I gave him a jar of our honey. You know, I'm a beekeeper, and we had a nice chat. And I was on Bloomberg Radio and TV that day. And then a week later, I got a email from a mutual friend, Dave Rosenberg, from Toronto, and he said that Rich had had a heart attack. He had apparently no oxygen, no brain oxygen for 30 minutes. He was in a coma, and Dave came down to New York, but then I got word that he had died, I think, the next day.
I had no idea.
Yeah.
I hadn't seen Rich in years.
Yeah, nice guy, really.
Funny
really
guy.
Super
a very
guy.
funny person.
Yeah.
He was always making us laugh.
Wow.
That's a shame. Wow. Sober
Reminds
note.
us of all of us of our own mortality.
We're all on our way out. We're
Yeah.
all on our way out. We're all in the same boat.
Right.
It's very true. Well, it's a pleasure having you on, and I mentioned to my audience that before this on Twitter that I was going to have the master beekeeper on, and I didn't tell you that I was looking forward to getting your honey. I wasn't going to ask because it was rude, but thank you for bringing it, and you brought one from my engineer too, which I'm so happy about. So,
hope you guys like honey.
Yeah, well, who doesn't like honey?
Oh, you're such sweet guys, you know.
All right, so let's get to the meat and potatoes. We got the honey, but let's get to the meat and potatoes. So I also want to mention to our audience, and I'll mention it again, you have a really incredible newsletter. Now, is Gary Shilling's Insight the only newsletter that you produce?
Yeah, it is. It's a monthly newsletter.
It is heavy. It is heavy, and you know what? It differentiates from all the other newsletters that I have read or have encountered because it's very heavy on indicators and on statistics and econometrics and stuff like that.
Yeah.
So I found it very useful.
Good.
And it's very current. So, you know, a few of the things that I want to cover today with you are things that were in the December newsletter, specifically taxes and regulations. And then we'll get into a lot of other things because we cover macro a lot on the program. And although I am interested in getting into sort of the deflationary expectations and things like that with you, I want to start with the tax cuts that are being proposed by Congress, as well as the regulations, the deregulation that the Trump administration is currently enacting.
Right.
Much of it is with executive orders, I believe, right? Or what's the term? Not
executive orders. It's executive orders, but it's also the people in the various agencies. And, you know, the federal government, if you go back to right after World War II, federal spending as a ratio to GDP was 16%. Now it's 22%. In other words, it's almost a quarter of the economy is in the federal hands, and it gives the president tremendous power, and that plus executive orders really can make a difference. I mean, Obama, when he was on the way out, he put in a lot of executive orders in the environmental area and holding back the pipelines, the Dakota Access Pipeline and Keystone XL and so on. And Trump has reversed a number of those. But executive orders are really interesting. They started with FDR, and he just put them in, and Congress never bucked him on it, and they've stood there ever since. They're really presidential legislation. So the president has not only the power over the agencies and carrying out the directions of Congress, but the president actually can make laws in effect.
Schlesinger wrote the book, The Imperial Presidency, and that was a reflection of the change in the role of the executive after World War II, really. That was much of what he did during the Great Depression and World War II was cemented. FDR, really. Yeah,
it really started because up until the Depression, the federal government had limited involvement in the economy, but the Depression was such a traumatic experience, and so many people had gone from riches to rags overnight, from the Roaring 20s to the gay 30s, that FDR stepped in, and you had all the New Deal programs and so on, and it greatly enhanced the scope and power of the federal government, and had all these agencies come in that nobody ever heard of, the SEC and starting off in financial regulation, and then CAB that regulated airfares, and of course all the more recent ones, Homeland Security, Department of Energy. Every time we have a crisis like the oil embargo in the 70s, they come up with new regulatory body, the Energy Department. After 9/11 in 2011, 2012, the Department of Homeland Security came in reaction to 9/11 crisis. So it's really done nothing but grow. And so the idea of deregulation is really a marked change. But the president, by putting people in these agencies, and part of it is just what they enforce and what they don't enforce. I mean, they have quite a lot of power in those agencies. But what it is, and deregulation, it's not a rose garden signing kind of deal. It's not. It's a little bit here, a little bit there, but you see it. The FDA, for example, they're speeding up the approval of new drugs. It costs $2.6 billion to bring a new drug to market. And consequently, speeding that up makes a huge difference. And, of course, particularly allowing generics. When generics come in, if there are 10 or 12 of them, the prices go down about 80% on average versus the patented, the prescription drugs. If there's only one or two, they go down about 40%. So opening this up, these are all very deflationary forces, by the way, which is my theme song for many years, as you know.
It is. Well, you were you're known as sort of the king of the long bond trade. Did you actually catch the very bottom of the bond market
I
in
really
81?
did. Yeah, wow. It was October of 1981.
Remarkable.
And as a matter of fact, I was about a month premature. And I'll tell you, it was... and I got in it by repos, repo trades, which are, there are, if you think futures are leveraged, repos are way out there. And I did this to a good friend of mine who had a small bond house. And I remember I got into it, and the first thing that happened in the first few weeks is I was losing money. And I said, oh, my God, here you are supposedly know what you're doing, and this is ridiculous, and how much hot water am I going to get into? Of course, I didn't even tell my wife what was going on. But it worked out, and by, that was 1981, and by the mid-'80s, this one vehicle, long treasury, 30-year treasuries, we'd achieve, let's put it this way, we'd achieve financial independence for the Shilling family.
Wow.
And
by the mid-'80s.
Yeah, by the mid-'80s. And
wow.
And they have outperformed the S&P since the early 80s by 5 times, long treasuries.
Wow.
It's really amazing. And it's, a lot of people just don't understand bonds. I don't know what it is.
They're boring. They're not sexy.
Well, yeah, they're boring. And of course, a lot of stock investors, they viscerally realize that when bonds are rallying in price, interest rates are going down. It's usually a time when stock prices are going down. So, bonds are personified. Anybody who likes bonds is really the devil personified. Yeah. But a lot of people just don't quite understand that bond yields, when yields go down, prices go up. And of course, people say, I mean, I remember way back then, I was running my parents' portfolio, and I don't think it's because they really trusted me, but their broker, some 30 years, had retired. So I was running the portfolio, and my mom called me up, and she said, Gary, I see you put some bonds in our portfolio. Are not going to mature for 30 years. And I said, yeah, that's right, Mom. I think it's a good deal. And, of course, the longer the maturity, the more price appreciation you get for a given decline in interest rates.
Right.
And she said, but, Gary, Dad and I aren't going to be alive in 30 years. And I said, that doesn't make any difference. And you look
You're like,
at it.
I will.
I had a really interesting experience with that with Jeremy Siegel of Wharton, University of Pennsylvania. He had me down for a conference addressing it, and he got up and he's a stock bull. He's a perennial stock bull, just like I'm a perennial treasury bull. But he got up and he said, I don't know, and the yield on the 30-year bond now it's 2.8%, well, it was 6%
And
at
this
the
was
time.
this was when you went?
This was about 10 years ago, I guess, and it was at Wharton. They have a course for sort of intermediate Wall Street types. It's a 3-year course where they go for a couple of weeks at a time, and he invited me down to debate with him. And he got up and he said, I don't know why anybody would lock up their money for 30 years for 6%. So it was my turn, and I said to the audience, what's the yield on the S&P? Well, somebody knew it was 2%. And I said, what's the maturity on stocks? Well, nobody knew. And I said, it's infinity, isn't it? I said, there's no maturity unless the company goes bust or the stock is called. It's infinity. I said, why would anybody lock up their money for infinity for 2%? That's apples to apples. That's the same question that people say with bonds, but it's really amazing how.
Well, I was also laughing when you were talking about it, when we were discussing your long call in 81, because Jim Grant is a friend, and he was on the show not long ago,
sure.
And he talked about his horrible call buying gold at the peak in, like, what was it, 1980? Was that the peak in gold?
Yeah, 79, 80 or something. It got to $800
an ounce.
Yeah, and
he said he stood in line, and he said the lesson he learned then was never stand in line to buy anything.
Well, and I think that's where we are with Bitcoins today.
Oh, man, you want to talk about that?
Why
we should.
not?
Let's talk. What do you think? So I'm curious, but it's something that we cover on the show, and the technology is something that I've covered. I started covering quite a bit. I have a sort of a background in that as well, in technology, not blockchain or distributed ledgers, but technology in general. And I've been fascinated watching the market around this, the frenzy, and just thinking about how problematic it's going to be for many people now that there are going to be futures trading around this.
And by the way, I started off as a physicist, so I've got a little bit of one foot in that area. Yeah, the interesting thing about speculations is they always start with some semblance of reality. The dot-com stocks in the late 70s were that way. Housing, with the relative availability of money with the subprime mortgages in the mid-2000s. There's always some semblance. But then what happens with speculations is it leaves reality behind, and it feeds on itself, and it's like Jim Grant standing in line to buy gold. Why are you buying it? Because it's going up. Now, there was a book you're probably familiar with called Popular Delusions and the Madness of Crowds.
Yes.
The guy named McKay.
Covered the tulip bulb mania.
Yeah, he and tulip bulbs, and it was a classic. There was a reason for that, because tulips were brought from Turkey to Europe in the 1600s, and if you've ever seen any of these magnificent Dutch still lifes in the 1600s, they just gorgeous pictures, and they always have all these fancy parrot tulips and other tulips. In other words, there was a semblance of that, but then the whole thing, the bidding got up and up and up and up and up, and then the thing they ran out, and that's what makes a top in any market. You run out of sellers, you have nothing but potential buyers. But the thing about tulip bulbs, in World War II, during the German occupation, the Dutch were so desperate they ate tulip bulbs. Now, I don't know there's anything you can eat on a Bitcoin.
No, well, it's really interesting. So, and something else, anecdotally, I don't have the numbers in front of me, and I don't remember whether it was what book it was that I had read it in, may have been that one. But some of the most expensive tulips were the equivalent in value of giant mansions.
There was one that was so many oxen and so many houses and cows and ships. I mean, a guy threw in everything he owned to buy one tulip bulb.
There's an interesting parallel there with Bitcoin. Not that these are identical scenarios, but there is a similarity in terms of the gross redistribution of wealth in our economy today. And I think it's telling that a cryptographic technology that allows you to essentially transfer and store large amounts of money has gained so much value in price, in other words. I think that is part of it as well.
Yeah, but you think about it, the only use that I can figure out for Bitcoins in today would the easy transfer of money through the electronic system. I mean, it's very cheap, it's very easy. The only logic of Bitcoins is money that you want hidden for some reason or another.
Right.
It's a drug traffic. It's the replacement for what the Swiss used to do. The Swiss had all their hidden accounts and so on, and then starting with the Germans and the Belgians and Dutch, and finally the U.S., we ran the Swiss banks out of that business. So
I definitely think there are use cases beyond that for it, but the problem is the use cases are limited because the technology is limited, particularly Bitcoin with its proof of work and the issues around scalability of the system. And it's very difficult to value. There's a lot of speculation around it. There's also I think something like 40% of the network or 40% of the tokens are owned by 1,000 people. So you've got a market that is, its valuation is very fragile. And I'm not talking,
But what would you use a Bitcoin for that's legal that you couldn't do with a credit card or a check or wire transfer?
One of the things I think Bitcoin offers is the same thing that gold offers, which is a way to store value if you don't trust the bond market and you don't trust assets. Let's say traditional assets.
Let's trust something that goes up or down 20% a day?
Well, I'm just saying. I think it's there are people that buy Bitcoin for the same reason that people buy gold, which is that it's a hedge against credit risk. I think it's a complicated conversation. I mean, ultimately, right now, I think what's driving the price is speculation. But it's such a difficult asset to value. You don't really know how you want to value it. It's not exactly a currency. It's closer to a commodity, and it's essentially an accounting identity.
Yeah, and you don't know whether this isn't a giant Ponzi scheme. I mean, sure, there's the algorithms you assign to mine it and so on and so forth, but nobody really knows who created these things, and you can't be sure that this guy tomorrow isn't going to double the supply.
Well, I think my sort of, not to belabor the point, but I think the big story is really that Bitcoin and blockchain technology has created the market for distributed ledger technologies and distributed consensus. They're attempting to do for the data layer, computation, processing, and storage of data, what the internet suite of protocols did for communication. And the thing is that blockchain can't scale. At least that's my sort of view on it. It can't scale in order to do the types of transactions, and it doesn't have the throughput or the security, in my view, but there is the sort of promise and hope for other technologies that are not blockchain. And I've been following one in particular and covering it on this show. And I think that is the sort of big opportunity and use case for distributed ledger technologies. It isn't this sort of narrow case of currency. But I do want to get into some of these things that are in your newsletter with you, like taxes, for example, and regulations. We were talking about regulations. Let's stick on that a little bit.
Sure.
The way in which the regulatory debate in the country is usually it's either or. It's very binary. Either you're for deregulation and I like that, or I don't like that. You're the devil, you're a saint, or you want to regulate, and that means you're a good person, you care about people, or it means that you're dumb, you don't understand anything. I come from the standpoint that there's some middle ground. But, I think to begin with, though, it's important to make the point, and you have a great chart in your newsletter that points this out, which is if you look at the cumulative number of federal regulations since 1970, which is where you have your start charts, it's just, it's basically a 45-degree angle, is, there couldn't be that many more things to regulate.
Yeah. Well, they always find new ones. And as a matter of fact, every time you get a big problem in the country, you get new regulation. The Department of Energy was set up in 1976. Well, that was after the oil embargo in 1973. Homeland Security in 2002 after the 9/11 in 2001. So you get these reactions. And the thing is that the regulation, it never goes away. The only regulation I know that has gone away in the whole post-war period, and that's the only time you really had big regulation at the federal level, was a Civics Aeronautic Board. That regulated airline fares. In other words, if you wanted to fly from here to Chicago, every airline had to have exactly the same fare. Now, a good friend of mine, now deceased, Alfred Kahn, he was a professor at Cornell, and he was head of the CAB, and he actually disbanded the agency. But it was interesting. They still found out ways to compete. On a particular run to Chicago, and this is true, they could serve sandwiches only. That was the CAB regulations on this lunchtime run. So the airlines competed to see what you could put between two pieces of bread and call it a sandwich, and one even put a full chicken between them.
Well, that you're basically touching on the problem of trying to introduce incentives into a market, and you're going to get it wrong often.
But regulation, there is a sense. For example, one of the things that Trump has delayed is the fiduciary responsibility. As you know, this means that investment advisors, brokers, have to do what's in the best interest of their clients. Now, to me, that's just ethics. That's common sense. But the rule now is suitable. And suitable can be something that's suitable for the client, but it has a lot bigger commission for the broker. Now, the big banks, and that's an interesting case because this was proposed earlier by the Labor Department. It was instituted under Obama. Now it's been delayed until next year for take a look at it with Trump. But the big banks,
they don't want to get rid of it.
Pardon me?
They don't want to get rid of it at this point.
They don't want to get rid of it because it costs them so much to adapt to this that unwinding it and redoing it would be a lot more expensive.
Sure.
I think they'd be embarrassed to tell their customers, well, we're going to go back to something that may screw you. But there are two principles there. One is that some regulation does make sense, and secondly, once you get it, you build a constituency, not only all the people administering it, but some of the people who are administered. But the point you're making, and this chart we have in our December Insight publication, it shows that regulation has just gone, well, you said a 45-degree angle, but it's just going straight up without any lapse. And that's the thing. And it does distort things from free markets. Now, you can say distorts things in good ways. Again, if you look back with brokers before 1929, boy, that was open season. Anybody who bought stocks was a lamb to be sheared. I mean,
that's
that was Buccaneer capitalism at its
completely.
best.
Absolutely. Well, you have another great chart, which is actually republished from data that was published by collected by PricewaterhouseCoopers and the Wall Street Journal, which shows CEO concerns.
Yeah,
and
right.
Tax cuts are being put at the very top, and the sort of the line from the Republican Congress is essentially, this is not a tax cut; it's actually a jobs bill. If our corporations are overtaxed, they are overtaxed, but then there's also the sort of the actual amount of taxes that corporations are paying, which is much lower than the 35%. But if we cut taxes, corporations are going to start spending. But we've actually, in one of our recent episodes with Lacey Hunt, we talked about this, and you have a chart of this as well, which is the capacity utilization of the country.
Right, yeah.
And that it isn't a situation where, firms they need to invest. They don't have the bandwidth to increase supply. And also there's the other argument that is put forward, which is that these corporations don't bring back the money to the United States because the taxes are so high. But one of this great chart, I think, speaks to something that I think we both agree on, which is that, in fact, at the very top are regulations, are not taxes. It's regulations, and below that is, in fact, cybersecurity, which is something else we cover on the program.
Yeah, well, just reading off that chart, 56% of CEOs put overregulation as their major concern. That was the top. And you get down to increase tax burden, it was 41%. And, it's much lower. You get down to protectionism, 27%. I mean, it was clearly the biggest concern. And it's, this regulation has just gotten out of hand.
But also, I think there's a case to be made that if corporations would do with money right now would be pay down debt and issue stock buybacks.
Collectively, and of course, there was a very clear reason for, well, 3/4 of the tax cuts go to corporations, and a key one reason for that is because tax system was just out of whack in a globalized world. We've got the highest tax rate, 35%. You go down to Ireland, 14.5% there at the bottom. But also, our taxes are collected wherever the money is earned globally. Other countries, it's done just within the country involved. In other words, if earnings are made in the UK,
right,
they're taxed in the UK and nowhere else, regardless of where the company's located. Well, that's why there's $2.6 trillion in money from Apple and Microsoft and so on that's technically stored overseas. Now, about 90% of that's invested in U.S. securities. It isn't as though repatriation is going to be a big boost to the dollar because they can invest in treasuries or stocks or bonds or anything else. They can't use it to pay wages. They can't use it for capital investments or to pay dividends, but they can buy any financial assets, and most of it's really gone. It's just a bookkeeping entry that runs through a foreign subsidiary or stays in a foreign subsidiary and isn't repatriated. So repatriation isn't going to make much difference. And you pointed out this capacity utilization. I mean, we're now well below. We're, I think, 77%. You got to get to the low 80s before. Historically, you've touched off a capital spending boom. In other words, if you've got surplus machines on the factory floor now that aren't working, why build more?
Well, we're pretty much kind of where we were, shortly after the 2008 crisis. We're kind of where we were in 2010 in terms of capacity utilization.
Yeah,
I think.
That's right. Yeah, it's actually it's been on a downward trend for many years. But but I just caution listeners. Capacity utilization is a very tough thing to measure because it really depends on the price level and supply and demand. I've been in industrial clients where you go in and they got state-of-the-art machines there, and then they got something over in the corner that was built 100 years ago almost. And you say, why you keep that? Well, if demand gets strong enough, we're going to use it. Well, that is potential capacity if the price is high enough, but it's not capacity at current prices. So it's a spongy kind of measure, but as long as it is consistently measured through time, that's all you care about. Absolutes very little importance in economic analysis. It's the changes, and if whatever the errors are, if they're consistent through time, then you still have some viable data.
Where do you fall on productivity? There are a number of economists who are very bearish on productivity in the U.S. economy. You differ in that regard a bit. Yeah,
a couple of points there. One is that productivity, as measured in this decade, is running about 0.5% a year. That is output per hour worked. Now, one reason that isn't the whole of productivity. Productivity is the output per unit of input, and the inputs are labor, their capital, their management skills, their technology. The other things other than labor, man hours expended, are very hard to measure. So they use output per hour worked. That's one problem. A second problem is that productivity is very easy. If you're talking about a punch press stamping out widgets per hour, you can get there with a stopwatch and time how many come out. But when you're talking about the productivity of the cell phone you got in your pocket, I got in my pocket, what is that?
Right.
That's hard to measure. How much of that is used productively for getting you appointments on time and useful information, and how much is just entertainment? It's very hard to measure.
It's a very, very hard thing to measure.
And then the third issue here is, and we got a chart in here that shows this, that the growth in productivity is just not linked to capital spending. The biggest correlation between capital spending is with productivity changes 4 quarters hence, and the correlation is only 15%. There's very low correlation. Why is that? A lot of technology only shows up moving the productivity needle years, even
it
decades
takes time to
later.
Mature.
And in other words, if you look at a new technology, and like now auto self-driving cars, barely, they don't make a blip in the auto sales. But in time, if they grow big enough, then they will have a big enough weight and they'll start to move the productivity needle. And I think the same is true of biotechnology, robotics, a lot of other new technologies. Even computers, I don't think, have reached their full potential.
Well, that, I think, speaks to what we were discussing before with blockchain technology and particularly alternative forms of distributed ledger technologies, because what, in my view, the most recent powerful innovation in technology was the mobile device. But before that, it was the internet, and the internet still has superseded mobile, in my view. Mobile is just a platform for delivering the internet and delivering services, but the internet itself was a protocol for communication. What DLT can do, if it can scale, if a solution can scale securely, is do for communication, do for data processing and computation and storage what TCP/IP and the Internet suite of protocols did for communication, which would be a revolution. Unlike anything we've seen, it would solve major problems or begin to solve problems of security and a whole host of other things. And that would be pretty remarkable, and that's a great example of your point. And that's very difficult to quantify and to measure and to sort of predict.
Yeah, it really is. And, of course, you get all kinds of unintended consequences. I mean, you look at retailing now on smartphones and really the whole online sales. I mean, it's just knocking the socks off the brick-and-mortar stores as people are ordering online, and Amazon delivers it, and UPS and other delivery services, FedEx, deliver the stuff, but the bricks and mortar guys are stuck.
And to go back to the point of the internet and productivity, and I think it's also important to draw a distinction. between what types of innovations you're going to see, because there are certain innovations that are really great for consumption, but not so great for production. I mean, the railroads were a revolution in terms of what we were able to do, in terms of what we were able to build. Concrete, steel, all these things. So I think, again, there is a distinction for me between the internet and certain other technologies and something like a distributed ledger technology, which would revolutionize and change so much of what we can do and drop costs and everything else, as opposed to, let's say, VR. VR can be a really great technology, but it depends on what the use cases are, and still it's difficult to sort of quantify the value proposition there. You could advance medicine for sure with virtual procedures, and there's empathic learning, and that could be very helpful. But so I think it also depends very much.
And you look at you look at all the social media. I mean, that does not contribute much to productivity. I mean, it's entertainment.
Oh, 100% agreed.
Consumption, but it doesn't do much for. As a matter of fact, you walk down the street and you got to be careful somebody doesn't bump into you because they got their head buried.
It's an interesting point. It's an interesting point you make. I'd have a hard time. I mean, I know that there are good things that have come out of social media. I'd have to really sit and think about it and tell you what those were. That's not a good sign. I mean, it's not. I mean, besides the fact that plenty of people waste time on social media at work, putting those obvious ones aside, there are a lot of other detrimental effects to it. I think earlier on, before the monetization engine really started to ramp up, it was more useful. There was more sort of value being created through the platforms. But now there's a dumbing down of the population, actually. There's a huge dumbing down effect that occurs through social media that is net negative. So, I think, that's a very interesting point.
Well, and also the idea of rapid dissemination of news and also fake news. The label on our honey jar this year is real news. Our honey is the best.
Wasn't the last one trumped or something like that?
Yeah, last one was nothing trumps our honey.
That was before you didn't know that Trump was going to be president.
No, we really had to take a chance on that. I mean, that was a gamble, and we weren't betting on Trump. We were just trying to pick something topical.
Real news, our honey is the best.
You look at what this does. I mean, for example, just today, some guy from Bangladesh had a pipe bomb that went off prematurely in the bus terminal.
Right by us.
Yeah, right, in New York City. Well, I guess it went off prematurely, and this guy really botched the job. He injured himself and 3 other people. Now, I'm coming in. I'm based in New Jersey. I'm coming in. I immediately know that. I'm worried, gee, do I have to leave early to get in, et cetera, et cetera, et cetera.
Sure.
It turned out the whole thing really was, obviously people injured, that's not good, but it really was no big deal. But the instant dissemination of that, and that was a true fact.
Absolutely.
But then you talk about some of the stuff that's disseminated that is really fake news, and you sort of say, there are some drawbacks to what's happening in social media and rapid dissemination of news.
No, absolutely. We talk about that much on the show. So let me ask you, in terms of specifics, what regulatory changes that the Trump administration is enacting do you think are net positive, and on top of that, positive for growth, and that you think will have a positive effect on equities in the next 12 months? An ongoing effect. I assume you think that they've had effect already.
I think some of the easing up on bank regulation is probably helpful. They've increased the size of the too big to fail banks significantly. What's it called? Significant financial institutions. That's not the exact name, but it was any bank with over $50 billion in assets.
SIGFI, I think,
was on this list, and now they've increased that to $250 billion from 50. Well, it meant that some banks that were just over that edge or close to it that wanted to merge, they didn't want to get into that too big to fail category. Mm-hmm. But now they can. So that's a plus. In other words, you've really opened up the free markets on that. Drugs, I think that's a very important thing. Mm-hmm. It costs $2.6 billion to bring a drug to market. $2.6 billion. Mm-hmm. Well, the FDA is now speeding up the process and foregoing some of the repetitive clinical trials. There's always a risk there.
Right, of course.
There's always a risk.
But there are many people who I know personally, and I'm sure you do, many people who are sick, who are frustrated very specifically by the regulatory burden of the FDA.
And these are all very deflationary things. That's a big benefit. But generic drugs, if and this is just a matter of statistics, if a pharmaceutical comes off patent and the generic drugs are possible, if there are 8 to 10 of those that are developed, the prices on average go down 80%. Mm-hmm. If there are 1 or 2, the prices go down 40%. In other words, there's more competition. Well, the faster the FDA speeds up the approval of these generics, the more competition you have, the lower the drug prices. So it's very beneficial, and again, it avoids excessive regulation. And again, the people who are involved in regulation will tell you that it is absolutely necessary.
Right.
The Consumer Financial Protection Bureau is certainly a case in point, where the diehard liberals they believe that this is absolutely necessary, that people have to be protected from themselves, that they cannot make rational decisions. And maybe that's true of a lot of people, but by the same token,
it's definitely true of a lot of people.
Well, payday lending, for example, with some of these annual rates that are hundreds of percent, right. People who are desperate for money.
These ICOs are a perfect example. Lots of people making crazy decisions, investing and not understanding what they're investing in.
But I think the difference between the Trump administration attitude, and I'm not a wild enthusiast about Trump, mind you, but you look at two situations. One is the net neutrality situation, where they're now saying that the internet providers don't have to treat everybody the same, that they can make deals up and downstream. They're opening that up, but at the same time they oppose the ATT merger with Time Warner. Mm-hmm. We say, what's going on here? I think what they're really saying is we're going to avoid antitrust collusion and so on. That's a vertical merger, and whether that should be a
well, the Democrats claim that that's.
Well, I think they're really saying that we're going to enforce the antitrust rules, but we're not going to regulate things day to day. And I think the problem with the people who believe in regulation, and Obama was certainly in that camp, and Hillary as well, is their attitude is if a regulation doesn't work, you got to have more regulation. They don't seem to ever be able to sit back and say, well, if it isn't working, maybe we ought to just go to something else. And so
do you think that certain places or certain ways in which regulation is helpful?
Oh yeah.
For example, I mean, just to point a few, I think I am concerned about the net neutrality, the sort of rollback to net neutrality by the FCC. In fact, I'm sort of on the mindset that we have a real issue, not just on the ISP level, but on the software side as well. There's in this increasingly technological world we're falling into, the control and power that exists in certain sort of very small, concentrated areas of the economy and the information economy is, I think, concerning. There's the other thing. I'm not an expert on some of the federal and private sector cooperative relationships that exist around the national parks and monuments, but that's also generally a concern for me, the fact that we're opening up those areas. And
but a lot of that's in the eyes of the beholder.
Exactly.
I mean
right.
Some people believe that those areas should be only available to backpackers.
Yeah, it depends on what
and
it depends
wild
on,
animals,
yeah.
and others say, wait a minute, there are minerals in there. There's you could raise cattle in there. You could hunting and fishing. You look at Utah, where Trump went out there personally to when they shrunk the size of these monuments, and the whole congressional delegation of Utah and the governor were in favor of it. Well, okay, it's an economic thing to them.
Sure.
They're saying, hey, we want more development there. We want more hunters. We want more fishermen, more cattlemen, sheep herders, and so it's But of course, you can always say, what's the proper balance between, in this case, the economic and the desire to have an environment and open spaces.
I think that the argument that the unfortunate reality is that a regulation in theory or an objective, when it's met with an actual practical regulation, often leaves so much to be desired. And of course, there's the law of unintended consequences. And the Federal Reserve is like a classic example of that, right? I want to bring it back to something. You mentioned deflation over and over again, and of course that's implied in your long bond call. Yeah. And we've talked about deflation a great deal on this program, and it's been something that we've been facing really this giant headwind since the financial crisis. And in some ways, it's almost become kind of, preparing for this interview again, like I cover a lot of things on this program, not just economics and finance. We cover everything. And, every time I have an economics guest, I want to find an interesting angle or an interesting perspective. And what I think I've come to see is that, and I think you've mentioned this as well, this story has become exhausting. It's just the same story over and over again, right? I mean, everyone's talking about the same thing. The Fed's meeting this week, for example. Are they going to raise rates? What effect is that going to have on the economy? Are we going to see inflation? Is it going to be a pickup in inflation? What's happening to gold prices? It's the same sort of talking points over and over again. I think that, bringing it back to this point about Bitcoin, I think part of the excitement around Bitcoin is this is like one market where there's volatility. I think that's why Wall Street's
been kind of dull out there.
Exactly. They're like, there's a party going on over here. Let's issue some options.
I want some action.
Right? Because there's this incredible lull, and I think that also creates that general unease. And we're all sort of walking around. We all know that this is not going to last forever. We've been around long enough to know it's not, except for the guys that are going short vol every day. You meet people like that.
I'm convinced that an awful lot of the interest of individual investors in stocks is the gambling instinct. They want to go to a cocktail party and tell somebody about how they got this 10-bagger. Somebody went up 10 times. Now, they never discuss the rest of their portfolio, but and that's why financial media really concentrates on individual stocks, even though all the research shows that if you want to see what governs the stock action, about 50% is the general market, another 30% is the industry, and that's only 20% left for what the president had for breakfast and what contracts they sign and who went to jail and all the stuff that they spend 90% of their time on. But I think it's because there is this tremendous gambling instinct, and it's an outlet for that. And it's the same thing you're suggesting with Bitcoins.
You're saying that the primary drivers of equity prices is not the news cycle. That's what you're saying.
No,
it's other factors. First of all, the animal spirits is the number one thing you're.
Well, it's what you could say what governs the overall market, but it's really saying if you want to decide on a stock buy or sell, you ought to spend most of your time on what's going on in the overall market, and that relates to the economy.
Well, that's why ETFs have been so popular.
And another 30% on the industry, and spend a minor part of your time on the individual characteristics of the company. But Wall Street analysts are paid to go. Well, first of all, they're basically paid to be bullish, and I know that I was fired twice by being bearish.
By Don Regan.
Don Regan and Merrill Lynch, you bet. So I understand that, but as I say, it's the whole emphasis is on it's really completely reversed.
It reminds me of a you've probably read, I'm sure, like so many others, the reminiscences of a stock operator.
Yeah.
There's that famous scene.
Jesse Livermore.
Yeah, Livermore. Yeah. Where he was Livingston his pen name?
No, I think that was his name, Jesse Livingston.
One was a pen name, one was the actual name. Livermore was his actual name, and I think Livingston.
I think it was Livermore, yeah. I think it was Jesse Livermore was his actual name.
Right, and but there was this one where he was on the floor, and there was this old timer on the floor, and he was walking around, and he's like, it's a bull market, remember, it's a bull market. And he had shorted the stock or something, whatever it was, and he ended up getting stopped out of his position, lost a lot of money. And the lesson of that, I don't remember, like I said, I'm paraphrasing it, but the lesson was essentially that it's much more important if you're in a bull market or a bear market to determine what position you should take on equities than the individual equity itself.
The trend is your friend.
The trend is your friend, exactly.
Yeah, that's
those
true.
macro forces, essentially.
Yeah. But of course, that's what makes this business interesting, because it's the turning points that are really important. We did some interesting work on that, because years ago people said, well, you got to be invested all the time, because if you're out the top 50 days, your return is going to be back to Treasury bills. So we did this research.
Which is not that bad.
We looked at this research in the entire post-war period, and we said, okay, let's suppose that you're out those 50 days, the best 50 days, but let's say you're also out the worst 50 days. You're way ahead. Mm-hmm. And because stocks decline a lot faster than they advance. Also, what's interesting is that you can be, if you sense that there's a top in market, the stocks are overvalued, and that looks like the case today, you can get out early, and if you are short, and that's where I made my big money in 08 particularly, being short, if you are short on the way down, you'll make much more money even though you gave away the last 10, 20% blow off at the top.
Because you went out in cash and you waited. How long did you wait before you went in? You started taking short positions.
Well, that's always tricky, and the problem is that nobody rings the bell when you get to the top. if you sense what's going on, and you really in effect say this is completely overblown. My strategy, and obviously there are a lot of different views, but my strategy is to take a small position, enough that you're not going to get hurt if it goes against
Wet
you.
your beak.
but one that you don't then feel the urge to rush in if it starts going for you, because there can be a lot of false starts, either up or down, and you don't want to be chasing things. You want to have a position so you can then build it at a leisurely and more rational pace than being panicked in or out.
When did you start going short the market? Do you remember when it was? Like when you started to sort of test the waters? Yeah.
Well, that was very interesting because, as you may know, I was very negative on housing. And it was an interesting story because we were doing a lot of monthly inside reports.
Does anyone ever confuse you with Robert Schiller?
Pardon me?
Has anyone ever confused you?
Yeah. CNBC, they've done that numerous times, and I just say,
they call you Dr. Schiller?
Bob Schiller's a good friend of mine, but I answer better to Dr. Shilling. Anyway,
I interrupted you. Please go ahead.
This was back in I remember precisely in July of 2006. A guy I never heard of before, John Paulson, was sent one of my reports by one of our clients at Goldman Sachs. He called me in because he was setting up this credit opportunity fund, which was buying credit default swaps.
Yeah, he made billions on that trade.
He wanted to set up an advisory council, asked me to be the first member, and I was very happy to do that. And then by about August, I realized what he was doing, and I've been
August of 2008.
I've been looking for a way to take a big a negative swing on subprime mortgages. And he had a very disciplined approach. With these credit default swaps, nobody believed housing could go down, so they were selling very, very cheap. And so he figured you could lose 25% collectively. And, of course, a credit default swap is basically a put.
It's an insurance contract on the mortgages.
Yeah, right.
On the CDOs.
And so at that time, the bill rate was about 5%, and so you're getting that on your money. You get that. So if 25%, and you figure that over 3 years, and the fact you're getting the 5% on that, it worked out that you could invest up to about 12 times leverage on these things. Well, we made 15 times on our money on that.
So you were invested in that deal,
and
I,
as I say, I figured it out by August, and I put what for the shillings was a major piece of change in September. And the first couple of months it didn't do anything, but then in early 2007, New Century had a very bad, which is a big mortgage company, had a bad quarter, and the ABX triple B minus, which is in effect an indicator for these credit default swaps, just went off the cliff.
Were you buying insurance only on the AAA tranche, or were you going? I mean, on the on the AAA. I mean, on the not the AAA. I'm sorry, on the mezzanine.
The triple B or the junk, which is of course below triple B. Right. But what was interesting about that was there were a number of other guys who were in this and got scared out and chased out by their limited partners when they were hedge funds because they were too early.
Right.
I mean, Paulson was not only right, but his timing was very good. It was, as I say, it was an amazing situation because it was a matter of figuring out what was going on, but also being right on the timing.
Well, for anyone in our audience who's seen The Big Short, Michael Berry is an example of what you're describing. That he was managing a certain amount of money. And he was very early on that trade. I think he went in 2006, and he was being bled dry. Another
guy who shows up in that, I've forgotten the name he used, is Greg Lippman. He was a guy with a slick back hair.
Right.
Greg, he's a friend of mine because Greg, interestingly enough,
how was he portrayed in the movie?
I've forgotten who he was.
He was what's his name played him?
He had a real slick back.
Yeah. What's his name
New
played
York
him?
Type.
Yeah. What's his name played him?
He had. It was interesting because in January of 2006. Greg Lippman had called me up and he said, I know you're negative on housing, and I'll tell you how you can make a lot of money. So he described this, and I never heard of credit default swaps, and I thought this guy was selling snake oil. Well, I just took these notes and I threw them in a pile. Well, then after I was involved, he was at Deutsche Bank.
Yeah. So he was played by what's his name in the movie Blade Runner? What's that guy's name? The guy that was in the Notebook. Let me ask my engineer here.
Anyway. So after I got involved in Paulson, this started to work. I was cleaning out this pile of papers, and I saw these notes from Lippman, and I said, good grief, this is exactly. So I called him up, and we set up a nice consulting relationship. He was at Deutsche Bank, then he branched out set up his own hedge fund. But what happened with him was that he was buying these credit default swaps. At the same time, other guys in Deutsche Bank were selling.
Right. Yeah.
And they didn't know that they were on
Right.
opposite sides of the same trade. Well, he ended up making about $2 billion and saved Deutsche Bank's bacon. But what was interesting is the authorities and this is what he told me, that Deutsche Bank came to him and he was losing about $50 million a month. And they said,
wanted to
hey,
buy him
Craig,
first.
this is what we had in mind. And they almost shut him down, but he talked him out of it, luckily.
That brings up another point, right? Which is that you stand to make a tremendous amount of money in a highly leveraged system. But at the same time, if the system breaks, everybody loses, right? I mean, the risk that you ran with that trade was that you wouldn't get paid out, right? I mean, AIG collapsed if it wasn't for the government that stepped in.
Well, it depends what you're in. I mean, we had in 2008, and we managed money, and our lowest performing account, which is literally a retired widow IRA, made 26%, and that was basically in long treasuries. Now, if treasuries go to hell, you might as well get your dried food and rifle and bottled water. It
is possible, though. Do you think it's? I know you're bullish on treasuries, but do you imagine scenarios in which that would occur, and what that would require?
Well, it would require a complete collapse in confidence in the U.S. government and the Treasury, and I don't know what would be left in the world, really, literally, except dry food.
What about some kind of constitutional crisis? Or, I mean, you can envision situations where the political apparatus of the country goes into crisis. I mean, those are.
Well,
theoretically.
We had that with Nixon.
With Nixon, right? What did happen to the bond market during Watergate?
Not much, as I recall. I know I don't remember precisely, but I don't think it was if it had been big, I think I would have remembered it.
Although it was a bipolar world, I would imagine that it would.
Nixon disbanded the link to gold, and
Right,
he
it
had
was
to
already on its
because
way
the
down.
gold was, we were linked to gold, and everybody else was linked to the dollar, and they through the dollar could buy gold, and they were just cleaning out the gold because inflation was raging. And yeah, at that point, Treasury yields were jumping up with inflation. Now, we had a chart in this newsletter that simply shows a very high correlation between inflation and Treasury yields. If you're right on inflation, you're going to be right on Treasuries. History tells you. So, but I think that was really the inflation. That was Watergate. That was the involvement in Vietnam and the Great Society, which just put way too much demand on the economy with federal spending.
Do you question our measure of inflation? And what do I mean here? I'm not talking about the everyday measure of inflation, that somehow the CPI doesn't actually or accurately capture that. What I mean is that so much of the inflation that we would normally see in everyday goods, because we used to have a strong middle class economy and a large percentage of the population was participating in the economy. Now with the lopsided wealth and income distribution, so much of the inflation shows up as asset price inflation. Do you think about that at all?
Well, let's put it this way. You can probably remember what you paid for gasoline the last time you filled up your tank, right?
Probably not, because I don't drive much anymore.
Within a couple of pennies.
Yeah,
Can you remember what you paid for the last refrigerator you bought?
No.
No. They're actually cheaper than they were 10 years ago, and that's without the quality improvements. A lot of the things that you
But
buy,
not real estate. Not real estate, not...
Well, housing declined. If you use a Case Shiller 10-city index, it declined 34%. It's now back, but it's still down about 10% from its peak. That's national house prices.
Well, so why does life feel so much more expensive?
By the way, housing prices per se are not in the...
We're also living in New York. Look, there is a point to be made that my anecdotal experience is built in here, but I do experience a rising cost of living, at least for the types of things we're describing here. I mean, the stock market has tripled. Not that that's a cost of living, but I mean, this is inflation. The question is that justified by the fundamentals? Is the asset price inflation we've seen?
If there's more money around, why shouldn't the guys selling goods and services to you and other New Yorkers get higher prices? I mean, it's
right. So I'm not. No, I don't mean it in terms of is it right or wrong. I mean it. We covered this in a way. I'm touching on something. This is important for the audience to remember as well. We had Sebastian Mallaby on the program. We covered the entire Greenspan, not just the Greenspan administration, but really Greenspan's whole life, because he wrote a biography on Greenspan. And there was a speech that he gave to the American Statistical Association in 1959 where he talked about asset bubbles and the wealth effect and financial stability, and what the Fed used to refer to as financial stability is asset price inflation. And, it's just something that we talk about inflation a lot, but I wonder how accurately we're capturing it considering the high level of asset price inflation.
Well, Barron, assets have inflated, no question about it. Real estate earlier, stocks more recently. Bear in mind, though, that most people think whenever they get a lower price, it's because they're great bargainers or wonderful shoppers. When the price is higher, it's the devil personified at work. That is just human nature. Very few people will admit or acknowledge that they get lower prices, and particularly when you adjust for quality improvement. You look at a cell phone today. This whole studio we're in right now, you couldn't have put enough electronic gear in there to do what your cell phone in your pocket does 20 years ago.
Especially this studio. Let me tell you something. You're not going to find many soundboards like this in the city.
There's a lot of switches on that board, I noticed.
This is very analog.
Yeah.
Looks like the flight deck.
Yeah, it did have kind of a museum quality look to it. but it's as I say, inflation is just routinely overestimated, and it is a measurement problem, but I think it also is a perception problem.
All right, so let me ask you this on a practical level. We didn't get to all the tax stuff I wanted to get into and all the regulatory stuff, but it's fine. I'm more interested now, before I let you go, to ask you sort of what are you projecting for the next 12 months? Let's say if someone wants to go long Treasuries, for example, how would you advise someone to do that? Like, what's sort of the easiest or best way? Obviously ETFs are a very easy way to do it.
Well, there's, you can buy Treasuries outright.
Right.
They're weekly auctions for Treasury bills. There's periodic auctions for notes, which are anything issued under 10 years, and bonds where they're initially over 10-year in maturity in terms of issue. You can buy them through mutual funds, exchange-traded funds. We use exchange-traded funds in portfolios that we manage where we're not using cash bonds. We use both. If you want more bang per buck, you get zero coupon, which give you a lot more movement. Of course, unfortunately, it works both ways. If rates go up, you lose more money. But they're readily available. It's the most liquid market in the world. It trades hundreds of billions of dollars a day. I doubt there's any of our listeners here who could have the slightest effect on the market by the amount they buy or sell.
Right.
It's just that huge.
Well, considering some of the regulatory cuts we discussed and the tax cuts, do you expect this rise in equities and this sort of the trends that we're seeing in the markets to continue for the next 1 or 2 years? Is that sort of your outlook?
Stocks are overvalued by a lot of measures. You mentioned Bob Shiller and his 10-year cyclically adjusted price PE ratio. Stocks would have to decline about 40% to bring it back to a long-term trend of, I think, 16.5, something like that. But having said that, you look at how do bull markets end. One of two ways. One is the Fed jacks up rates to the point they kill the economy. And by my reckoning, in 11 of 12 times the Fed has tried to cool off the economy with higher rates, they've resulted
in a tightening
recession.
cycle.
Now, from the time they start jacking up the Fed funds rate, and there's a chart in this insight on that, it can be years before that happens, but that's eventually. The other thing that happens is a shock, like the dot-com blow-off at the end of the 90s or the subprime mortgage collapse in the mid-2000s. So you say, well, what's going to occur first? Something's going to happen. Is the Fed going to jack up things and kill the goose, or is it going to be some shock? Bitcoins, that's not big enough probably to do the job, but if that takes off for a year or two, maybe that would do it. Or you can conjure up anything,
geopolitical,
North Korea, or blow up in the Middle East. There's nothing.
Saudi Arabia. What do you think of that? That's an interesting one, right? Because that feeds
really
into energy.
Yeah.
I think that's an under-talked about story.
Yeah. Mohammed bin Salman, the now designated next king, is really trying to reshape the country, and whether he's going to pull that off.
You can see a movie now in Saudi Arabia.
Without revolt. I don't know. He's buying Rembrandt. He's buying media, or Da Vinci rather, paintings. But a shock is possible. But I've made a career. The last book I published is called The Age of Deleveraging: Investment Strategies for a Decade of Slow Growth and Deflation. And I listed in there, I think, 8 what I called great calls, and they all were shocks that I had predicted, luckily, and seen these bubbles developed. And well, I don't see anything right on the immediate horizon that really equals the dot-com nonsense of the late 90s or the subprime exuberance in the mid-2000s.
That is true. There is nothing like that.
No, there's nothing like that. Now, this Bitcoin, if it ran a couple of more years and really sucked in enough people, it's possible. But it's still pretty young. It's still a fad. It hasn't become a national sport quite yet.
Right. Well, you're talking about a market event, but there could be a recession which could drive it.
Yeah. Oh, sure. Sure. But as I say, historically, those recessions are Fed caused or a shock. I mean, it was probably more the collapse of the subprimes in the starting in 07, really the end of 07 that caused that 07-09 recession. The Fed was tightening a little bit, but only a minor part. It was the collapse of housing. I'm going to,
so you know, Dr. Shilling, we put up book lists and everything on the website, but also for our audience, I'm going to remind you, and you can find it on the website, but if you go to GaryShilling.com, you can find Dr. Shilling's newsletters. I assume these are subscription service newsletters.
It is.
And well worth it. Like I said, these stand out. I've read many newsletters. These stand out for the amount of data that you have in them. I want to ask you one more thing. One thing I was thinking about before we did this interview, before I came in here, was I was thinking about energy and I was thinking about oil. And I was thinking about all the books that came out in the mid-2000s, Twilight in the Desert, like Out of Gas, like The End of Oil, all this stuff, right? And I think one of the most unlikely scenarios that anyone could have conjured at that time in 2006, 2007, 2008 with 140 Brent would be that we would be where we are today with energy. And I think carrying on to that point, one of the most underreported stories out there is Saudi Arabia. And you want to talk about not being able to price risk. How about the price of the political instability in the kingdom, the potential for an Arab Spring or something worse, really, to manifest in a country that has that level of control over its population and is that dependent on patronage through its oil revenues?
Yeah. It is, and it's obviously a major oil producer. It's the second largest exporter behind the Soviets, or Russia now. Yeah, it could be.
You were short oil for a while. You're no longer short, right?
No, I'm not, because right now the current thinking is that most of the good fracking sites are close to a peak. That's the Hubbard's peak of yesteryear.
Right. We got it's the second Hubbard's peak. It's the camel.
That OPEC and their allies are going to be able to cut back enough to reduce excess inventories. I'm not convinced of that long run, but at the moment, I just don't want to stand in the way of that freight train. And we made very good money in oil short earlier, but right now,
like I'm
not long.
Bit.
I'm just on the sidelines. But
do you think Russia would join forces with OPEC in any way to try to help for geopolitical reasons? Do you see that happening?
Well, Putin really wants to reestablish the Russian Empire,
right.
so he is operating in Russia's behalf. Right now he thinks it's an advantage to join with OPEC. But you talk about this back in 1978, which was sort of between the first and second oil crisis. I wrote up a report, and it really said that human ingenuity beats shortages any day. And I used a couple of interesting examples. One was whale oil. They
right.
That was used for lighting, and they thought they were going out.
It was really popular with the whales.
Well, what happened? Colonel Drake drilled a well in Pennsylvania. It was kerosene they wanted, and the remaining whales were saved. and New Bedford, Pennsylvania, or New Bedford, Massachusetts, is now just a whaling museum. There's no whale ships anymore.
Right.
And another one was the Industrial Revolution. I took my family down to Williamsburg, Jamestown, Virginia, and the original colonists were trying to figure out how could they make money because they were importing most of their goods from England. Well, glass blowing was one of the things they did, and they were exporting glass to England. Now, you think about making glass things and putting them in ships, and what was the odds of their arriving unbroken? But the reality was at that time the Industrial Revolution was underway. They were denuding the English countrysides of hardwood timber to make charcoal to smelt iron.
Yeah.
They ran out of hardwood, and so it was economic with plenty of wood in Virginia to make the glass there. Well, then what happened? Some ironmonger in Shropshire, wherever Shropshire is in England, figured out you could make coke out of coal.
Yeah.
And that saved the remaining hardwoods.
It's a remarkable story. You're a big fan of history. I know that already.
Yeah,
but
human ingenuity beats shortages any day. It always has anyway.
It works both ways. I mean, we're pretty ingenious for all sorts of things. Not all good.
Good and bad.
Dr. Shilling, thank you so much for coming on to Hidden Forces. I really enjoyed having you on the program.
It's been a great interview.
I was sorry
to
hear about Rich. I did not know about that. But,
yeah. Well,
he was a funny person.
Yeah,
I had very good memories.
It was a real shock. It was a real shock. He was a friend of a lot of people, but just very sudden. And as I say, I just talked to the guy a few days before he had this I think it was a heart attack. But went into a coma and died.
Well, we're all passing through. And on that note, Dr. Shilling, I wish you safe travels wherever you're going next, and I hope to do this with you again sometime in the future.
Well, same to you.
All right, thank you. And that was my episode with Gary Shilling. I want to thank Dr. Shilling for being on my program. Today's episode was produced by me and edited by Stylianos Nicolaou. For more episodes, you can check out our website at hiddenforcespod.com. Join the conversation through Facebook, Twitter, and Instagram at Hidden Forces Pod, or send me an email at dk@hiddenforcespod.com. Thanks for listening. We'll see you next week.